One of the most interesting things to come out of the US election result last week was not necessarily the result of the election itself, because, has often been stated throughout history, you will never go broke underestimating the intelligence of the general public. What I found interesting was the response of markets in general, particularly markets in the US, and this becomes more apparent when you look at the segmental nature of US markets. If we take a look at the 5-day trading returns from major US indices, we see a series of very disparate responses. The biggest gain was in the Russell 2000, the lowest in the S&P 500. So you have two distinct tails. You have the bottom end of the market being represented by the Russell 2000 doing very well. Next comes the Dow, the idiosyncratic collection of 30 stocks, followed by the broader US market. So you have a very, very lumpy recovery. You have the pointy end moving very quickly, and you have the base moving very quickly. But that bit in the middle, what we would probably term the wider blue chips, has not moved at all. And this is an intriguing thing. This is very, very interesting that a market that appears to be outwardly uniform displays such a disparate response to a single event. However, the point I'll make about the single event is that politicians come and go. Geopolitical events come and go. And as I said last week, the sun still comes up. People go about their day-to-day business. So it is intriguing that we do have this very, very different response to a single event. And what is interesting is when we look at those markets that are trying to move to new highs, the Dow has actually moved to a new high. Now, personal disclaimer, I have a system that trades new highs, so I am automatically long this market. But as we can see, very good recovery week. But as I said before, it's not a recovery that is uniform across the US. If we look at the S&P 500, it doesn't look as positive, it doesn't look as energetic, and it is still some way off its previous all-time high. You can see the reversal on the day of the election, but there isn't the follow-through that the Dow actually had. So the broader market itself is perhaps not as convinced or not as enthusiastic in terms of this market segment. And we can see this if we take a longer-term view. One of the points I will make is that bull markets have a variety of phases to them, a variety of legs, if you would call it that. And you can see it here. You can see this is the broadest interpretation I can give of the bull market post the GFC. But you can see an initial acceleration, a stalling in 2011, a second acceleration, and now this consolidation. Nothing that happened last week convinces me that this consolidation in the S&P 500 itself is over for the time being. It is still a market in search of a new high. And it's intriguing to try and find a structural reason as to why this might be. And to be honest, I can't really find one. This is the comparison of the Dow Jones cumulative 52-week high and lows versus the S&P 500 new highs, new lows. And as you can see, they look pretty much identical. There is not an obvious difference between the two that I can find. Yes, pre-GFC there is a difference, but post-GFC into the current period, there is not a standout feature that makes me go, well, that's the rationale as to why that has happened. Granted, you could construct some form of narrative, but that's really just my story. And only the market will vote on whether my story is correct or not. If we look at a comparison between the Russell 1000 and the Russell 2000, that is, where we split the Russell 3000 itself into top 1/3, bottom 2/3, you can see the difference. You can see that the lower portion of the market, as shown in the first graphic, is much more energetic than the upper portion. They look functionally identical up until this point, but you've got a market that is very, very different in its response to a single event. And the only rationale I could come up with for this is that you get an immediate fill-up at the very, very pointy end of the market, and then you get a perception of a segment of the market being fully valued, if that's the sort of lexicon and language you use, whereas the lower half is perceived as not being fully valued, simply because of this extended going nowhere period that the Russell Index itself had. But again, only a story. I can't think of another reason as to why this might be. In terms of our local market and its response, you can see the rejection trade on the day of the election, follow through the next day, follow through the day after. But, and this is a big but, to my eye, it appears that we are still locked in this downward channel. New historic highs seem to be a long way off for our market. It simply doesn't seem to have the energy it requires to get going. And again, the rationale for that is probably there is 1.5 trillion in superannuation, the 6 trillion in investment real estate. So there's huge disparities in cash inflows into markets, and markets need cash inflows to get going. And that will remain a problem for our market for some time. And this is just a longer term view. You can see that our high is some way off, and we are still below the breach of support we had from the modest uptrend we had at the beginning of the year. In terms of things that are interesting in an emotional response to elections, precious metals are a wonderful example of people's stupidity. The intriguing thing is, in the week leading up to the election, my spam folder got innumerable emails from people saying that either side was going to be elected, therefore gold was going to $5,000 an ounce, followed by either side was not going to be elected, therefore gold was going to $5,000 an ounce. The unfortunate thing about gold is that it is surrounded by a bunch of hysterical idiots who are seemingly incapable of understanding what the true role of gold is. Gold has never been a hedge against inflation, nor has it ever been a store of wealth. Perhaps back in the days of the conquistadors, but that's a long time ago. The world has actually changed since then. Unfortunately, survivalist nuts who think that you can eat gold haven't woken up to that fact yet. And these idiots exist both here and in the US. If we were to look at this chart, it looks in some ways almost like a poor mirror image of the Dow. And that's understandable because it is subject to the same emotional perturbations. Again, personal disclaimer, I'm actually short gold. My short-term system picked this up on the day of the election and went short. If it goes further, my longer-term systems will pick it up and also go short. The same is true for silver. I'm also short silver and will go short again if we get a breach of this support line. And this is the final talking point I want to mention. And this has relevance to our domestic market. As we saw earlier, our domestic market is struggling, it's drifting down. However, there is a bright spot on the horizon for people who trade special situations, for those who look at things like the composition of the small ordinaries, which is largely a collection of dodgy mining stocks. That is that the base/industrial metals have been very, very positive. And whilst I cannot give advice, and this has just been a general discussion of things that interest me, if I were trading domestic equities, what I would be looking at is stocks that match up with these various industrial metals that are actually doing very, very well. because they provide some form of impetus, some form of energy that our local market desperately needs.